right, here we are again, another ICT concept to teach you. Institutional and interbank order flow. What's the difference? You're probably like, interbank order flow. I've heard the term interbank before, but what does that mean? Interbank order flow is simply whenever fair value gaps are getting respected in a specific direction, in which institutional order flow is simply when price is respecting order blocks in a specific direction, giving a confluence that price is going to continue in that direction. Real simple, right? Because if you don't know where the institutions independently buy at, like where they just a single institution, let's just say one singular institution, right? That has billions of dollars, where they're going to buy and sell at or hedge positions at is going to be at order blocks. That's their primary method. Okay. Now, of course, the algorithm offers different opportunities, yeah, but that's mainly for adjusting their positions. But where they initially hedge positions and add on to positions, order blocks. That's where you're mainly going to see that for when it comes to just independent institutions. But when it comes to transactions, this is what interbank means. Transactions between multiple institutions, that's where the fair value gap part comes in. Because when it reaches a fair value gap, what's happening is literal transactions between institutions, like literally. So, like for example, this fair value gap here, price came up, touched it. I know you can see it right there. Hold on, let me just get the fair value gap thing. You see it drew up into it. What's happening here is when price retraces up into this fair value gap, let's say the institutions were wrong, in which we know 99% of the time they're correct. They know everything about this market. Let's say they, I don't know, put too much into the market or they're simply down. What they can do, or not what they can do, but what the algorithm will do is it'll purposely reference this fair value gap to offer the institutions that are in the red a chance to offset some of their positions. Offset meaning close or to simply buy back some of their position. You get the point. If they're in longs and price is dumping, you can refer back to this fair value gap in which the institutions, listen to me here, in which the institutions that are buying can sell their buy position to other institutions that want to sell at this fair value gap. That's why I call it a direct transaction. That's why it's called interbank order flow. Get it? It's not that hard. So, for example, like I said, again, let's say someone was longing up here, some institution was longing over here, and now they're like, uh-oh, we're in the red, we're in the red. The algorithm purposely refers up into this. I've explained this before. It purposely refers up into this to offer who opportunities. Well, who is it offering opportunities? It's not just necessarily buys and sells, but who is it offering it to? Smart money. Me, you, institutions, interbank, those people. That's smart money. So when it references this fair value gap, it is offering smart money an opportunity. An opportunity to do what? Based off whatever situation you're in. Since we have a situation, hypothetically, that an institution or a institutional trader is in the red up here, like after buying, the algorithm will refer to this gap, allow them to offset some of their positions to minimize their loss, in which the institutions that want to sell at this fair value gap can buy their or can sell the buy position that is being offered from the institutional trader that's in the red. You know what I'm saying? So it's basically like a trade off. It's really simple. So let's see. Let's go to. We're gonna move back over to interbank order flow in just a minute. That was just like a little intro example. I do that sometimes, but anyway, let's go through institutional order flow. Real simple. Let's go to a point in price where price was really going one direction, like not really going anywhere else. Let's see if I can find it. Let's go to the 4 hour. All right, yeah, this is a pretty good example. I'm not gonna lie. So we have this entire order block right here, which is one candle on a higher time frame, but of course on this time frame it's consecutive candles. So we'll mark this as an order block. And you're probably like, okay, how do we identify institutional order flow? And you're probably like, when you say institutional order flow, is it like a general thing, or are there different types of institutional order flow? There's different types. There's bearish and there's bullish. If you're seeing down close candles and or bullish order blocks getting respected, then there's bullish institutional order flow. Simple. Now, when it comes to interbank and institutional order flow, which one is on top? Which one is more important? Which one has more of a confluence on the market? Definitely institutional. Why? Because think of it like this. How are you going to move the market if you're already in a position? It just doesn't make any sense. How you really move the market is when you initially place that position. That's where you really move the market. If you got $10 billion already in the market, it's not really gonna do anything. It's just not. Like, you can have 10 trillion just sitting in Bitcoin over 50 years and nothing will really happen. But if there's money going in and out of it, then yeah, of course that market's going to move. So what's happening with institutional order flow, like I said earlier, when they are referencing, not they, but when the algorithm is referencing these order blocks, institutions are what? Hedging. They're buying at these order blocks. So when they are initially buying, that's going to drive price and add more liquidity to the market. And guess what? The algorithm is doing all the time, creating facades for retail to fall for, in which smart money, which is me, you, and Interbank, we will buy their liquidations, the retail's liquidations, the dumb money's liquidations. We will be buying their liquidations to drive this market and basically manipulate it however we want. It's real simple. So when price references this order block 1, 2, 3, and 4 times, what's happening here is that institutions are buying. Institutional traders like just what's the word? I can't really explain it, but like kind of like freelancer institutional traders, like some that are just by themselves, but have good knowledge on the market, but they don't associate themselves with hedge funds and companies. They're basically just alone, like a lone wolf. Like that's basically what I'm trying to get to here. But institutional traders, hedge funds, private equity, all that's interbank has billions and millions of dollars. They're buying at this order block. That's why institutional order flow is on top of interbank because that initial entry or placing of their position is what's going to drive the market because they're actually putting their liquidity into the market and causing this market to move. Get it? So we have one order block here, and then we have basically another order block, basically because it's just a different type of order block, which is a propulsion block because it's the deepest down close candle that reaches this order block here. So we can delete this one. Hold on. In which this one is now hold on, where's it at? Propulsion block. There we go. In which when we break above its high, we activate it, break above it, refer back into it. Next candle digs into it a little bit more, which I think we respect its equilibrium pretty well. Yeah, we respect its equilibrium pretty well. And then we have another algorithmic signature right here, the immediate rebalance. Got that potential gap that could have formed between this body and that candle's high, in which the third candle simply wicked down, immediately rebalancing after having what? After having the hedge funds or basically smart money in general throw their liquidity into the market to cause the algorithm to actually drive itself. Okay. So basically, we are offering liquidity for the algorithm to do its thing. They're like, well, that's kind of where we are. We're kind of like the middleman in a sense. We're kind of like the monkey in the middle. Not really, but retail is like the monkey in the middle, but we are really the liquidity provider so we can actually manipulate retail. It's a long story, but I think you kind of sort of get what I'm saying. But the institutions and algorithm are constantly working together. This is not a coincidence. The fact that we reference this order block 1, 2 times, in which in those 1, 2 times we are forming a very, very algorithmic signature, which is an immediate rebalance, in which price delivers right after, that's not a coincidence. Not at all. Nope, not at all. Understand? Because what's happening here, if you want a little explanation, one more time, the algorithm needs some form of liquidity to what? To go and hunt this liquidity up here. What's up here? Stop losses for shorts and buy stops. Real simple. Do you know what a buy stop is? You should. It's basically just a pending order for when price reaches above this point, they're going to buy. So what they need to do in order to go up to that point, they need liquidity, they need funds, they need money. That's what the algorithms need. So it offers the institutional traders, remember, we are opportunists. Us smart money, me, you, the institutions, interbank, we are opportunists. So the algorithm will offer us opportunities to offer liquidity to it so the algorithm can actually do what it needs to do and drive, in which its main driver is what? Liquidity and gaps. That's the two main things that drive this market. So moving on to the other order blocks that are in this run, we have another order block right here. Right there, those two candles. You're like, what about this candle right here? First off, price didn't really displace away from it. Secondly, it got violated, so I don't think I need to explain that. Drawing this out. Hold on, let me just get it real quick. Oh, there we go. The order block or order cock, as some people call it. We refer down into the order block. Let's see, one, and then really this is two. This whole swing is a two right here, but you get the point. So 1, 2 institutions are buying. Let's see what's happening here algorithmically. Hold on. Oh wow. Do you see that? Oh my goodness. Is that real? Yeah, that's definitely real. Definitely real. We hit the equilibrium, close below it, but do we go past it? Do we have a willingness to go past it? Do we actually like really really go past it in price? Like, can we see that, oh my God, it wants to go through it? No, we clearly don't see it. It literally hits the equilibrium and stops right around there. Not even right around, like very, very close to it. So you get the point. The algorithm and the institutions are working together all the time. This is not random at all. Price might not be perfect, but it's definitely not random. Understand that. Now, we're going to do one more example of, let's see, before price completely, reversed, one more example of institutional order flow, in which we might just use this example here. Yeah, we'll use this. Did it even hit? No, it didn't even hit that order block. I think on the higher time frame, like on the 4 hour, this is an entire order block right here. It should be. Let me mark this as like a vertical line and come back to it. Hold on. Okay, let's see where it is. That one candle should be. Oh, yep, it is. Just one singular candle. See that? So let me just delete that line. You'll be able to find out how it's a singular candle in a minute. It just takes a whole lot of time and experience of just knowing how these markets function and knowing how the time frames look based off one time frame. It's real, real simple, but you will get it over time. So order block right here. This is the 4 hour. This is really an institutional time frame. But anyway, we jump above, activate the order block above its high. Next candle refers back down into it. Does not hit the equilibrium. That is a good thing. In which what's happening here? Institutions are longing. Real simple. They are longing here. In which when I always stutter there. When we reach above these highs, what the institutions have an opportunity to do is sell their positions that they accumulated down here at this order block. Real simple. I talk about that deeper in another video called offset accumulation and distribution, in which if you want to go learn the concept I literally just mentioned just now about the selling up here, then you can go watch that video and learn more about it. But after you watch this, of course, don't just click off yet. Anyway, no, definitely not recent time. Oh my God. Yeah, no, we're not even gonna, no, I'm not even gonna take you through that. Okay, I think I found, something a little decent. So we can clearly see that previously Interbank was selling heavily. Okay, Interbank was selling heavily. Because reminder, if there is no liquidity in the market, what can't the market do? It cannot move. It is that simple. It cannot move. So the interbank is the liquidity provider in which the algorithm is simply the manipulator. Very, very simple. So what institutions are doing here is selling, and the algorithm is simply driving that liquidity to cause this market to move lower. Easy, right? Yeah, real simple. So previously we had what? Obvious bearish institutional order flow. Real simple. Now, moving on to this year, I'm going to mark a bunch of fair value gaps I got respected, which is this one here. And I think there was another one. Yep, that right there. And is it this one? It might be this one. Hold on. Ah, no, not that one. It was the one above it. Oh, there we go. Right there. And then I think there was another one. That's on like the 30-minute right there, but there's a couple more right here. And then of course it, starts chopping. Whoa, what the world happened here? But you get the point. Anyway, here is 4 points of reference or 4 examples for us. Not really examples, but points of where the algorithm offered an opportunity to have the institutions do some trade-offs. So we're going to mark this as fair value gap, mark this as fair value gap. Like I said previously, there's a reason I mentioned this previous price action. Previously, price was what? Selling off. That means the institutions are selling too. So, whenever price refers into this, listen to me, refers into this fair value gap, what's happening is the institutions or private institutional traders or freelance institutional traders or companies or hedge funds that are selling this move, if they are, for example, not out of their positions before price starts shifting right around in this area when fair value gaps start forming, right? Because what do fair value gaps show? What's in a fair value gap? Specifically, this bullish fair value gap. What's only there? Only buys. So when they see this, they're like, "Oh, we might gotta get out of our position. We might just need to. It might be over for us. So we got to start taking out. We got to start getting out of our position. Real simple. So since there was previous bearish order flow, now what's going to happen is when price refers into this fair value gap, the institutional sellers in that previous move lower, they're going to be buying back their shorts in this fair value gap, in which the institutional traders that want to long at this fair value gap or potentially get into this move or even add to their position from a previous order block right here, what they're going to do is buy back the sell positions that the institutions or institutional traders previously had in this move here. So the shorts that were here are going to be bought back from the institutional traders that went along in this fair value gap. So it's a direct what? Direct interbank transaction. Or if you say transaction, same thing. Same thing at this fair value gap here before price truly shifts above that high right there. Once it breaks above that, that is the, where's it at? Where is it at? I literally cannot see it. Oh, break of structure. I'm an idiot. But here we go. Refers to it. They buy the shorts previously in that previous move. Again, buy, buy, buy. See this? Are you seeing it? Are you understanding? Now, watch this. Pay attention to this, right? You notice before price shifts, it gives these people that were selling, not necessarily people, but the interbank that was selling in this previous move, it gives them 3 opportunities on just the hourly, of course, on just the hourly. It gives them 3, 1, 2, 3 opportunities to exit their shorts before price shifts. Now you're probably like, but it gives them another one here. That's not necessarily the problem, but look at when and how it does it. After the break in market structure, do you see any other opportunity after that? Or do you see that? You probably like, oh yeah, duh, JJ, we see it right there. But do you see it any other time? No, no, you don't. So this is basically proving my point. This is proving my point on how the institutions directly interact with the algorithm, or how smart money, which is all of us, all of the people that know ICT concepts or understand these concepts in general, how they, I said they, how they directly interact with the algorithm to manipulate it. You notice that's the last opportunity that was very, very close in proximity to the shift. But notice after the shift higher, it barely offered them an opportunity to exit their shorts. Crazy, right? Yeah, it's pretty crazy. Now, this alone should have taught you a lot just on understanding how the market actually works. And it gives you a pretty good confluence too, mainly the institutional order flow part. But the interbank part really just gives you more of a deeper understanding of how the transactional part works. But either way, it's still confluence and you're still gonna use this, right? Hopefully you use it whenever you see it occur. Of course, I'm not gonna sit here and say, "Oh, use this one concept. It's the holy grail, 99% win rate." No, we don't do that around here. We put confluences together and make a narrative out of it and trade it. Anyway, enough of me yapping. I've been talking for about 20 minutes now. Might gotta edit some things out, but this is the end of institutional and interbank order flow, and I'll see you in the next one. Good luck and good trading.